The General Journal is covered in Chapter 7 of Neville Box. The reason why we have journals, obviously in the information flow of accounting we have our source documents. Absolutely every accounting transaction has a source document. And then we process these to our journals. The journals contain all the individual pieces of information, which we then post onto the ledgers as a summary of information. The General Journal is used to record infrequent, non-cash transactions that cannot be recorded in any of the special journals. So just to remind you, the special journals are the cash receipts and cash payments journals and the credit sales and credit purchases journals. Now, all cash transactions, cash is cash is cash. It has to be recorded. Doesn't matter what it is for. If it is coming into the business, it is our cash receipts journal. If it is going out of the business, it is our cash payments journal. Our purchases journal is only for the recording of creditors that we use to purchase goods and services for resale. So only creditors that we purchase from for the goods for our business. Credit sales journal likewise then lists all of our debtors. It is just for debtors who purchase our goods and services from our business in our ordinary course of business. Therefore, the General Journal is just for those end of month sort of transactions or anything else that's infrequent. We'll go through the list individually. Okay, so one of the infrequent non-cash transactions are called commencing entries. So this is when we're either beginning a business or we are transferring balances from a single entry accounting system into the double entry accounting system. Okay, so it's at the commencement of the business. We post existing asset, liability and owner's equity balances used to establish double entry records. Obviously, we do not transfer expense or revenue accounts. We just begin with our balance sheet items and then we process on from there. Okay, so there are two different situations where commencing entries will be used. The first one is at the startup of a business. So what we have here is cash contributed. So we're not just transferring a balance here, we're actually beginning the business. The owner is contributing $60,000 of their own cash. Therefore, this entry is processed in the cash receipts journal. Remembering our cash receipts journal, we have then when we do our bank reconciliations, we have our cash at beginning, plus and minus cash incomings and outgoings, and we have our cash balance at the end. So this will obviously contribute, this $60,000 will contribute to what our bank balance at the end is. Then we have our non-cash contributions. So this goes into the General Journal. It's not a part of trade, we're not dealing with anyone else, we're just commencing our business. So we need to record it. Remember, the information flow says we have source documents and then we go into the journals before we can go into the ledgers. Here you'll see vehicle, which is a non-current asset, is increasing because the owner has contributed a vehicle worth $35,000. They've also contributed equipment, which is worth $5,000. So the capital contributed here, the non-cash capital contribution, is $40,000. And here you go is the source document, Memo 01. That's what they would keep in their accounting system. These details, I'll just try to reduce it a bit, are then processed, as you'll see down here, into the ledgers. The ledger it replicates, so bank is increasing. So our bank has a debit balance in our ledger. Our vehicle, as you'll see, is a debit here. So in our ledger it's entered as a debit, and our equipment likewise is $5,000. The contra entries, or the credit entries, which then balance this out, remember it's double entry, every credit has to have a debit entry, is over here. So we've got our capital is increasing and it consists of cash at bank, vehicle and equipment contributions. So the total balance is $100,000. There are times when there is an opening or a commencing journal entry, and in actual fact the owner is also contributing a loan to the business. So it might be that the vehicle was purchased partly with finance, so that $35,000 might be the agreed value, or it could be market value, and this just could be the corresponding liability against that asset. So it is right to do that if the business owns or becomes the legal owner of the asset, then they also become the legal owner of the debt attached to that asset. So we do include that in our opening accounts, and as you'll just see, then in our capital account, all it does is, trying to be clever. All it then does is it just adds a debit value to our capital. So this is just for commencing entries. We won't see that again. We'll end up with a balance in our capital account at the beginning, and it'll be affected by that. So this is the only time at a commencing entry that you'll actually see a loan listed in our capital account. So the other type of commencing entry is if the business has been it's an ongoing entity, it's not a new entity, but they're just starting a new accounting system. Here you will see we do include cash at bank in our general ledger. The reason why cash at bank is included here in our general journal and not in our cash journal is that we're not contributing any extra money. This is just going to be our bank balance. It is the bank balance which is left from the previous accounting system. We're just transferring balances here. So in this instance, yes, we do put our cash at bank in the general ledger. It's the only time that will happen. As you'll see, we also have our debtors control listed, which consists of N Pylon and E Gulbis, and they're listed individually in our subsidiary ledger because we need an opening balance in each of those subsidiary ledgers. We have our stock control. We have our fittings, which is fixtures and fittings, light fittings and shop fittings and all the rest of it. And then we also have, we transfer our accumulated depreciation balance. That doesn't just disappear, that's an ongoing entity, remember the going concern principle. We have our GST clearing, which is a liability owed to the ATO, our creditors control, which consists of Ace Sports. We have a loan from OK Finance, and we also have capital. So assets contributed by owner at commencement of double entry system. So please just be aware that cash at bank, if it is the very beginning of the business and the owner is contributing, physically opening a bank account with new cash, it goes in the cash receipts journal. Any other time that we're just transferring balances from one accounting system to the other accounting system, cash at bank is included in the general journal. Okay, other things that go in the general journal: non-cash transactions with the owner and the use of stock for advertising purposes. So non-cash transactions with the owner will be when an asset is contributed as part of capital, or when stock is removed. Stock, or it could be, there's a computer that's been the business's computer and the owner decides to take that home. So that they're the types of transactions we're talking about. And here's an example of that. So the owner is contributing a desk to the business. It is not cash. It's not, a transfer between a debtor or a creditor. So we process it in our general journal. It's not going to happen all the time either, so it's infrequent. And we increase our assets, office furniture $200, and we increase our capital by $200. That's an agreed value, I would assume. The agreed value, remember, being it doesn't have a source document in terms of a receipt, because it could have been purchased 2 or 3 years ago, but there would be some way of working out the market value. With office furniture, it might just be the replacement value if you had to go and buy it, and you might even, in part of your memo, just have a catalogue with a similar sort of item just to justify it. Or if it was a car or something like that, you'd go onto Cars Point and you'd find a similar car, and that would then become the foundation for your decision for that to be the agreed value. Here we have withdrawal of stock. So drawings is increasing. So drawings, remember, is a negative capital item. So we're reducing our capital by withdrawing funds, and so that comes from debt. It's a debit entry. And stock, which is a current asset, is reduced. So that's the credit entry. You'll note here that there is no cost of sales attached, and that's because we haven't earned revenue from this. We've just literally walked in, taken $100 worth of stock out of the business. So we record the value of the stock here, just as drawings and stock control. When we donate goods or services, I guess, but goods from a business, we actually don't call it a donation, we call it advertising. The reason being, a donation legally and by definition is when you give something without expecting anything in return. However, when we donate goods from our business, it's a form of advertising where they would promote our name, and we would hope that we would actually get more customers as a result of that. So it's a business expense called advertising. Stock control, so stock is reduced, so it's a credit entry, and our narration says owner donated 2 footballs at $50 each to the local school, memo 31. So you do have to generate just some form of it. Would be maybe a letter that they've written requesting a donation, and you just write the memo, take a photocopy of it and put that in your accounting system. Memos can be actually that easy, or they can be more formal. They may have to be written out properly. It's just keeping a record of exactly what the transaction is related to. Okay, so bad debts. These include expenses incurred when debts are written off because they are deemed to be irrecoverable. And we've also got closing entries that we need to look at. So what is a bad debt? A bad debt is when you have got a debtor, you've made a sale in good faith, and you're expecting payment in the future, but it's just not going to happen. So our conservatism promotes that the minute that we recognise that an expense is likely to occur, that we record it. So if it's a cash purchase or whatever, that's fine, but in terms of our asset, we don't want to overstate our assets. We're better off understating them. We're being prudent. And so we just say, okay, we're not going to rely on this money anymore, and we write it off as bad debt. This is done in this, here we go. So it is as simple as this. A bad debt is an expense. So we debit the bad debts account, and then we credit the debtors control account with the amount. We also then need to record this in the debtors control account, so the subsidiary ledger, because we don't want them to appear anymore in our debtors schedule. They're not coming back. We want it to be a zero balance. So whatever the balance was, then we just write it off. Debtors account written off as irrecoverable, memo 67. Then down here we will see our debtors control account. We're reducing our debtors control, so it's a credit entry for $200, and we're increasing our expenses by $200. Our subsidiary ledger looks like this. We had sales and GST clearing when the sale was actually recorded on January the 31st. By the end of the year, we realised we're not getting it back. We just want it to go back to zero. We'll record the expense, call it a loss, and move forward. So correcting entries need to be entered. These include if a debit and a credit have been recorded incorrectly, so that our balances reflect what they actually should be. I will go through this in a little bit more detail in a separate slide. Just so you know that the General Journal, you need to have a narration. It describes each journal entry, including a reference to the source document. That's vital. The General Journal is posted to the General Ledger at the end of the month, so it increases or decreases the balances to reflect the current state at the end of the financial period. I hope this has helped.